Hey, my name is Keith Hall. I'm a CPA and I work exclusively with small business owners just like you. One of the questions you're going to have to answer for yourself is what entity form are you going to operate your business under? It's going to be a corporation, an LLC, a partnership, a sole proprietorship. A big question to answer, but let's talk about S corporations. Relatively unique form of organization. Now, in another video we talked about the corporate form of organization, and reminding you from that video, the corporation kind of gets stuck in this double tax potential. And that's basically when the corporation, which is a separate legal entity from its shareholders, ends up paying tax on its own. So there's income at the corporate level, they pay tax on their own. Then when the corporation pays money to its shareholders in dividends, the shareholders have to pay tax on that again. That's the double taxation problem. Now, a long time ago, the IRS recognized that small businesses might want to have the liability protection, which is one of the key benefits of the corporate form of entity, want to have those benefits, but don't want to get stuck in this double taxation. So the IRS came up with an S election, or an S corporation, small business corporation. You can elect to be a small business by filing IRS Form 2553, and basically what that does is it allows the S corporation to not pay tax at the entity level. So the corporation still has the same detriments of the regular corporation in that it has to file articles of incorporation with the state, has to keep track of board of director minutes, shareholder minutes, all the little jump through the hoop paperwork to maintain that liability, which works perfectly okay, except the S Corp gets to pass its income through to its shareholders. So now the shareholders who own that S Corp are going to pay the tax rather than the corporation. This is a great benefit of the S corporate form of organization. So it has pass-through taxation, but still has the liability limits. Now, this is very similar to the LLC form of organization that we talked about in the other video. The difference is the LLC is newer. The S corporation has a few other detriments that have been kind of fixed, if you will, with the advent of the LLC form of organization. For example, an S Corp can't be owned by another S Corp, so it is limited as to whom its shareholders can be. An S Corp also is limited to the number of shareholders that it can have. There's also some problems with the fringe benefits with attribution rules. I won't get a bunch of detail on that, but if a shareholder that owns at least 2% of an S Corp, they can't have like health insurance benefits or some other fringe benefits because they're considered key shareholders, and if they're also an employee, some of those benefits are not deductible for the S Corp. The attribution rules mean that the spouse of one of those 2% or greater shareholders is also considered a 2% or greater shareholder. So the point is there's a couple of limits, a little bit of complicated issue. The S corporation can certainly be an effective form of organization, but if you're thinking of an S corp, you might also consider reviewing the LLC video, because a lot of the benefits in the S corp are also available in a limited liability entity form without some of those cumbersome record-keeping issues or attribution rules that make the S corp a little more expensive, a little more cumbersome to deal with. Still, you can avoid the corporate double taxation issue by making an S election on the corporation that you've already formed. So that gives you a couple of options. Think about the LLC, think about the S corp, can help you with the liability, also avoid some tax. Thanks for watching. Don't forget to check out the links above and the links below for more detail. Also, make sure to rate, comment, and subscribe. If there's something else you would like to see, just let us know. Email us at request@mahalodotcom.